Accounting can feel like this super complicated, almost foreign language. But really, it's just the story of a business. It's a journey that starts with one tiny event, a single sale, and ends with the complete financial picture. So let's break down exactly how that happens, step by step.
And that's really the big question, isn't it? How does one small thing, like selling one little item, eventually get transformed into the data that guides huge multi-million-dollar decisions? That's the exact path we're going to trace today, from that one tiny data point all the way to the full story.
All right, so everything in accounting, and I mean everything, starts right here. It starts with something called a transaction. You can think of it as the raw material, the very first sentence in the financial story of a business.
Just think about it for a second. Any little thing a business does that involves money, a customer buying something, the company paying the rent, an owner putting cash into the business, each one of those is a transaction. They are the fundamental building blocks of the entire system. Without them, you've got nothing to account for.
Okay, let's make this real. Imagine we're running a plant shop. The story might start with the owner investing $2.5 million to get things going. Boom, that's a transaction. Then, a big customer buys $430,000 worth of plants, but on credit. That's another transaction. We buy supplies for $870,000. We pay the rent for $120,000. See, each one is a separate piece of our financial puzzle.
So now we've got all these different transactions floating around. It's basically financial chaos, right? How do we bring some order to it all? Well, the answer is this really elegant system that's been the bedrock of accounting for literally centuries. And this system is called double entry bookkeeping. Its main idea is so simple, but it's kind of revolutionary. Every single transaction has two sides. A two-for-one deal. If money leaves one place, it has to arrive somewhere else. By recording both a debit and a credit for every single event, the system has this amazing built-in error check, making sure the books always stay in balance.
Okay, let's go back to our plant shop and that rent payment. When we pay that $120,000, our cash account goes down. That's a credit. But at the exact same time, our rent expense account goes up by that same amount, and that's a debit. So you see, one transaction, two perfect equal and opposite entries. The system stays balanced. When it comes to cash, there's a really easy way to remember this. When cash comes in, you debit the account to make it bigger. When cash goes out, you credit the account to make it smaller. It's that simple. Debit what comes in, credit what goes out. All right, so fast forward a bit, we've been busy recording hundreds, maybe even thousands of these little double entries. How on earth do we know we got it all right, that we didn't make a mistake somewhere? Well, it's time for a critical sanity check. This is the moment of truth for any bookkeeper. This checkpoint is called the trial balance, and its whole purpose is just beautiful in its simplicity. You add up all the debit balances from every single account, and then you add up all the credit balances. And those two numbers, they have to be exactly the same. If they are, awesome, we can move on. If not, well, it's time to go hunting for the error. And this is that moment of truth. We just list out the final balance of every single account we have, cash, sales, rent, everything. We put all the debit balances in one column and all the credit balances in another. Then we hold our breath, we total them up, and if that double entry system did its job,
They match perfectly, down to the last dollar, $8,093,000 on both sides. This perfect balance, this is the green light we've been waiting for. Now we can move on to the final, and most important, stage.
So our numbers are checked, they're confirmed, they're balanced. Now we get to do the really cool part. We take all of that raw data and we transform it into something incredibly useful. We create the financial statements. This is the company's official report card.
And this report card has two main parts. First up, you've got the income statement. This is kind of like a movie of your business over a set period, like a month or a year. It shows your sales and your expenses to answer one simple question. Did we make any money? The second part is the balance sheet. This is more like a photograph. It freezes a single moment in time to show exactly what the business owns versus what it owes. And really, that's the whole point of this entire exercise. This whole process exists for one reason, to create clear, reliable information so that people, investors, managers, owners, can make smart decisions. It's all about communication. The final step is actually pretty straightforward. It's just a big sorting game. We take our perfectly balanced numbers from the trial balance and we just sort them. All the accounts related to revenue and expenses, they go over here to build the income statement. And all the accounts that track what you own, what you owe, and the owner's investment,
they go over there to build the balance sheet. And just like that, we've gone the full distance. We started with one single transaction, we organized it all with debits and credits, we checked our work with that trial balance, and then we finally built the reports that tell the full, complete financial story of the business.
So the next time you look at a financial report, I hope you don't just see a bunch of numbers. See the final chapter of a story that began with a single transaction. A story of success, maybe a struggle, maybe growth. The only question left is, what story will yours tell?